a story, a narrative started that the reason we're in such trouble is because with a free market, with free corporations allowed to do whatever they want, everything's going wrong. Now, if that lesson is the lesson that the public learns, then we have failed, and free market principles have failed, because it's the wrong lesson, I believe, to be learned. And yet that was at least the initial story. It justified the starting of financial re-regulation bills, all the new interventions. Well, we have to have more and more interventions because look what happens when greedy men and women act on their own interests. Well, greed has been a constant factor since we've become humans. You know, that doesn't go up and down. Some people have greed in their hearts, others don't. I wanted to raise to the panel to discuss briefly what role government policy had in creating the problems that we have, perhaps including Fannie Mae and Freddie Mac, other policies. Was this the result just of greed amongst human hearts, or were the policies, non-conservative, non-free market policies, that exacerbated or maybe even more contributed to the economic crisis we've had? French, you want to start with that?
I'd love to start out on that topic. Housing policy in the United States, since back in the day when Bob Woodson and I were in the vineyards in the early 80s, and Tony was as well with Jack Kemp, housing policy has always had a bias towards more people owning houses in the federal government. And that started out by having interest deductible. And it's expanded over the years to where really now the federal government controls well over 95% of every home loan in the country. And those incentives, people react to those incentives. And we've tried to make it easier and easier for people to own houses at all income groups. And at some level, you know, maybe that was a reasonable policy. But people react to incentives. And in my judgment, it was government policy that drove the concentration of investment assets into residential mortgages and the packaging of them given by tax policy and regulatory policy. And it was government policy that made an exception to a 75-year-old rule, which was the capital standards for broker-dealers, and exempted the top 5 dealers from the normal leverage ratio. And that's an example of government policy and how it skews outcomes. And so to blame it 100% on the private sector like they operate independently of the incentives placed out there by government, our government and other governments, is, you know, it's wrong. It's wrong to lay the blame at their foot.
Well, let me ask you one other question on that. I don't know what the answer is, but some experts believe that the Fed's policy of creating extraordinary liquidity contributed to the problem. Now, the Fed, while technically owned by other banks, is substantially a governmental activity. How do you see the Fed's policies over the years leading up to this as contributing to the problem?
Well, monetary policy through the Fed post 9/11, you know, has been too lax. And my friend John Taylor out at the Hoover Institute at Stanford has the Taylor Rule, which he tries to model from past behavior what he thinks the level of interest rates should be. And universally, during the decade, it was too accommodative. Monetary policy was too easy. And that led to an overinvestment in housing for 3 years, 05, 06, 07. But to me, that is a part of the crisis, Tony. But the underlying crisis was this effort to make everyone in America, regardless of capability, a homeowner through gamesmanship in the terms of a mortgage that Fannie Mae or Freddie Mac would buy. That makes no sense on the surface of it. But you combine that with the fuel of accommodative monetary policy, and you got we've reaped what we sow over that decade, and we're living with the consequences.
Dan, do you have some thoughts?
I think you've raised a key issue, because the economics is one thing and who's to blame is one thing, but it's the narrative that's important. And what lesson do we learn? Because for decades, and even still today, we suffer from a gross misinterpretation of what happened in the 1930s. Under both Hoover and Roosevelt, we got protectionism, higher tax rates, more government spending, more intervention, and we suffered 12 years of an economic downturn. It was big government, including bad Federal Reserve policy, that caused all the problems, but what do all the history books say? It was the fault of capitalism. And I think Tony has raised a key question, because if going forward, people blame free markets and greed for the economic problems that we had last year and into this year, we're going to suffer the same way that we suffered for 40 years after the Great Depression, the other side effectively blaming free markets for problems caused by governments. And this whole notion of greed causing the problem is really amazing. It's sort of like saying every single airplane crash is caused by gravity. Yeah, okay, that's true. But does it actually tell us anything about why the plane fell to the ground? And as Tony said, there's always been greed there. But when you mix greed with a central bank creating too much liquidity, so you have all this extra money sloshing around in the economy, and then Fannie and Freddie sort of tilt the playing field, so all that liquidity sloshes into the housing market, you create a bubble. And what happens with bubbles? They burst. And so government created the problem, and then what happens? As is always the case, government compounds one mistake with others, and they bail out the companies that tried to ride the bubble too far and too long. And as a result, we've now created a huge moral hazard in our financial system with companies that are too big to fail. And what happens when you get to bet with other people's money? You take greater chances. Here's a great idea. Everyone in the room, give me all your money. I'm going to go to Las Vegas. And every time I make a bet and I win the bet, I'll keep the money. Every time I lose a bet, it'll come out of what you gave me. Would that make sense? Only in Washington, D.C., and that's the way the financial crisis has been handled. And I am terrified that the history books 30 years from now are going to say this was the fault of free markets.